Hey guys, Roger Herring here, founder of Investors Accounting LLC, and I am the Investors Accountant. Welcome to this segment of Ask Roger. And recently I had a new client that asked me, Roger, why couldn't I deduct my real estate losses? Well, there are very specific rules around deducting losses from rental properties. Okay, so let's go over them. The first rule is if you are a passive real estate investor, that means all you did is write a check and you get a check back every month. You can't deduct any losses unless you have passive income, and then you can deduct losses up to the amount of that income. What happens to the leftover loss? It carries forward indefinitely until such a time as you can use it. When you have passive income, well, how would I get passive income, Roger? Well, you might have a rental property start throwing off profit, and then you can go back and recapture it. But the most common way is you sell the property, and that creates passive income. Now, the second level of real estate investment is the active participant. An active participant can write off up to $25,000 of phantom loss from rental real estate every year. Phantom meaning it's not real. It was created by depreciation. So they can write that off until they hit $100,000 of adjusted gross income. Then they go into phase out. So for every dollar over $100,000, they lose 50 cents of their maximum deduction. So at $150,000, they are totally phased out and they are treated just like a passive investor, and their losses carry forward until they can use them. That was the case for my particular client. He got phased out. He said, well, is there a way around it? Yes, there is, if you qualify for level 3. Level 3 is being a real estate professional. Remember, that's what I call the goose that laid the golden egg, because a real estate professional has no income limitations and a real estate professional has no limit on deductions. All right, that's why it's the goose that laid the golden egg. I've got clients that haven't had to pay taxes in years because they're real estate pros. Well, Roger, how do you get to be a real estate pro? Well, first off, you have to spend more than half of your working time in real estate in an owner's capacity. So that means if you've got a full-time job and you're working 2,080 hours a year, you have to have more than 2,080 hours in real estate specifically. That's part 1. Now, there's part 2. You have to have a minimum of 750 hours spent in an owner's capacity in real estate. Well, that can be in flipping, that can be wholesaling, that can be being an agent or a broker, that could be being a landlord, that could be being a property manager. Well, you say, Roger, that's easy. Is that all I have to do? Nope. There's one more requirement, and most people don't talk about it. They don't even know it's there. You have to prove that you have material participation in your rental activity. Well, what the heck does that mean? Material participation means that you spend a minimum of 500 hours per year across all of your rentals. That allows us to make what is called an aggregation election and make you a real estate pro. So, more than half of for-profit time, minimum of 750 hours across all real estate, with 500 of those 750 hours being spent directly on the rentals. That makes you a real estate pro, and that's where wealth lies. So, if you got any questions, go ahead and inbox me. And hey, be sure that you click down below and subscribe to us, and you will never miss any of our videos. We talk about small business issues, but most specifically, we talk about you, real estate investors. So, till the next time, I'm Roger Herring, the Investors Accountant, and I'll say as I always do, Roger out.